You see, the biggest mistake people make is assuming the stock market is a simple scoreboard for the economy. Good economy, stocks go up. Bad economy, stocks go down. But that's not really how it works. Let me explain. The stock market is not a happiness meter. It's not a how are normal people doing meter. It's not even really a is the world peaceful meter. The stock market is a machine that prices four things: future profits, interest rates, where money is flowing, and what traders are being forced to do right now. Once you understand those four things, stock market all-time highs in the middle of chaos stop looking mysterious. But they might start looking a little bit disturbing. Most of us are taught to think about the economy like this. If the world is calm, businesses make more money, people spend more, companies grow, and stocks go up. If the world is chaotic, businesses struggle, people spend less, companies make less money, and stocks go down. That sounds logical, and sometimes it's true, but only sometimes. The thing is, the stock market is not the economy. It's mostly a collection of big public companies. That means the stock market can go up, while ordinary people are struggling. Look at this chart. It shows how much of the S&P 500 is made by each company. And what you'll notice is that the index isn't as evenly spread out as people imagine. A tiny handful of giant companies make up a huge share of the whole thing. So when you hear that the S&P 500 just hit a record high, that doesn't necessarily mean the whole economy is booming. It might just mean that the biggest companies in the index are making enormous profits, or that investors believe they're going to make enormous profits in the future. Meanwhile, your rent can still be unaffordable, your grocery bill can still hurt, your wages can still feel like they're going nowhere, because the stock market isn't the economy. Sometimes it's just a scoreboard for the companies powerful enough to dominate it. Here's the second key idea. Markets don't always rally because the news is good. Sometimes markets rally because the news is less terrible than people feared. Imagine you walk into school thinking you completely failed a test. You were expecting a D-. Then your teacher hands it back and you got a C. Is a C amazing? No. But compared to what you expected, it feels like a win. Markets work the same way. If investors are expecting the worst case scenario, such as oil prices exploding or trade routes shutting down, then even a tiny reduction in that fear can make stocks jump. This is why something as innocuous as one of Trump's tweets about getting closer to a ceasefire can cause markets to rally. Now, let's talk about interest rates. And we'll make this really simple. When interest rates are high, keeping money in the bank is more attractive. But now, imagine the bank cuts interest rates. Suddenly, more investors start thinking, why would I leave my money in the bank earning almost nothing? Or maybe even getting eaten by inflation? I'd rather buy something that actually gives me a better return. So, they buy businesses, houses, stocks, gold, anything that might make them more money than cash sitting in the bank. And when lots of people want to buy the same assets, the prices of those assets go up. After the 2008 financial crisis, central banks cut rates aggressively. During the pandemic, rates were also extremely low. The economy was crashing, so making money cheaper to borrow was a great way to try to get people spending, lending, and investing again. And that helped push up the price of almost everything: stocks, houses, bonds, private companies, collectibles, and even random internet coins with dog logos. But here's the weird part. Recently, rates have been much higher than they were during the post-2008 and COVID periods. So the old explanation, stocks are only high because rates are low, doesn't fully explain what's happening now. This is where we need to talk about deficits and crisis spending. During a crisis, governments spend a lot of money to stop the economy from collapsing. Sometimes that money goes directly to ordinary people. Sometimes it goes to companies. Sometimes it goes to banks. Sometimes it goes to defense contractors, energy companies, or bondholders. And over time, a lot of that money can end up in the hands of people and institutions that already own assets. Now, here's the important part. When regular people get extra money, they usually spend it. They pay rent, buy food, pay bills, fix the car, replace the washing machine. But when very wealthy people or large institutions get extra money, they buy assets, stocks, property, bonds, companies. More extra money accumulating at the top means that demand for these assets rises, and when demand for assets rises, asset prices rise. That's why the stock market keeps reaching new highs. It's a sign that wealth is becoming more concentrated at the top. If you already own lots of assets, rising prices make you richer. If you don't own assets, rising prices make it harder to ever catch up. Politicians will point to stock market records as a sign that everything is going well.
The stock market has set 53 all-time record highs since the election. Think of that, 1 year.
But in reality, it's proof of inequality. This is why the pandemic represents the biggest wealth transfer in history. There's another layer too. People are losing trust in cash. When governments keep printing money during every crisis, money starts losing its value, since more money in circulation means that the money everyone already has is less valuable. The US government is currently around $39 trillion in debt, and it's paying roughly $3 billion a day just in interest, not paying the debt down, just paying the cost of carrying it. In this fragile economy, instead of holding cash, investors move the money into assets like stocks, houses, gold, Bitcoin, anything they think can hold value better than currency. Now, let's get to the point most financial news barely explains. These days, lots of trading is done automatically by algorithms. And algorithms don't sit around debating geopolitics. They look at price. If the trend is down, they sell or short. If the trend flips up, they buy. So when stocks suddenly jump through certain levels, these systems can flip from bearish to bullish. That creates another wave of buying. Then comes options dealers. Options are basically bets on whether stocks will go up or down. A call option is a bet that stocks will go up. But here's the weird part. Sometimes one small piece of good news can turn into a huge rally. When lots of traders buy these call options, the big firms selling these contracts